Hello and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this edition, we're going to take a dispassionate look at the bond markets. Why are foreign portfolio investors rushing to buy bonds, snapping up close to $2 billion worth in just 5 trading sessions to last Tuesday? Could it be that they're finally discovering the power of the bond market? And here let me digress a little to what former US President Bill Clinton's political advisor James Carville once said about the bond market, and I quote, "I used to think that if there was reincarnation, I'd want to come back as a president or the Pope or as an ace baseball hitter. But now I would like to come back as a bond market. You can intimidate everybody." The Indian bond markets may not have quite got there yet, but the combination of recent announcements in the budget and the RBI's monetary policy announcements seem to have set bond markets on fire. So in this edition of Macros with Mythili, we're going to take a hard look at the recent announcements and their implications for the bond markets. And joining me in this are two experts, in fact stalwarts, close observers of the bond markets, Suyash Chaudhary, Head Fixed Income, IDFC Mutual Funds, and Jayesh Mehta, MD and Country Treasurer, Bank of America. Welcome to the show, Suyash, Jayesh. The Economic Times editorial on the budget announcements on the bond market was quite rah-rah, saying reliance on the opaque bank funding would come down as a consequence of the hike in limits for overseas investment in corporate bonds from 9 to 15%, removal of any cap on non-resident investment in specified government securities, withholding of interest payment abroad, wider scope for credit default swaps, etc., etc. Basically, the hope included in this was also of being included in a global bond market. How much of all this will really impact the bond market as we've seen? Because though on paper it would certainly seem to be a great development, over the years bond markets in India have really not lived up to expectations, and India remains a bank-driven economy. Do you expect this to change, Jayesh? And I'm limiting my questions only to the budget announcements. Jayesh.
So I think budget, people went into budget with fear of what will be the current year expansion of borrowing and what would be mainly for 2021. And I think in both the case, it's been curtailed, and that's kind of gave a relief to the bond market that, okay, fine, there's not enough extra borrowing coming, because, there were all kind of numbers floating in around maybe 1% extra and stuff like that. So that gave a little flip there. Along with that, the long pending index inclusion, which is what we started somewhere in 2013, and then at that point of time the index guys were saying that keep up the entire limit quota completely free. But I think now we have two bond index guys, and there are precedents in the world where few select bonds with no limits and cap get included in the index.
So Suyash, I think Jayesh seems to think the fact that we're not going to be borrowing very much more in the next year, and also the promise of inclusion in the bond indices is the bigger factor. But soon after the budget, the RBI followed up on the budget announcements with a promise to not only keep liquidity accommodative, but to conduct long-term repo operations, LTRO, of close to, or not close to, of actually 1 lakh crore, in effect promising to keep liquidity easy at a time when liquidity is already in surplus. In fact, it has already announced 2 LTROs of 25,000 crore each on the 17th and 24th of February. What is your best guess of the market reaction to these LTROs? What is likely to be? And also, how wise is it to try and push down yields somewhat artificially like this? Is the recent decline likely to be sustained, Suyash? I know 3 questions combined in one, but please, if you can be brief on all 3.
So the context of this is, if you recall, for a very long time we have been struggling with the problem of transmission, and the backdrop is that over the last financial year the nominal growth rate of this country has collapsed by 300 to 400 basis points, whereas rates even in the traded bond market have actually fallen much less. So the problem of transmission has essentially got 2 components. One is elevated term spreads, and the other is elevated credit spreads, at least on certain specific companies where the risk perception has deteriorated somewhat over the last 1.5 years. Now, clearly the elevated term spread is something the RBI could have addressed, and in fact it's been our view for some time that RBI should move to address the elevated term spread, even as they can do very little with respect to the elevated credit spread as it pertains to a set of specific companies. So each of the recent RBI operations, starting from the so-called Operation Twist, where they have been selling short-term bonds and buying long-term bonds, right up till the promise of easier liquidity and the latest long-term repo operations. We are basically going to look at from this lens that these are all moves towards greater transmission. The issue, or what one has to monitor, let's say 6 or 12 months down the line, is that the RBI also has to be quick enough to withdraw these exceptional measures when in fact they start to see growth gaining more ground.
We'll just come to that a little later, and the impact of overseas portfolio investment in bonds. But Jayesh, do you expect RBI to do more LTROs? In fact, is there a case for more LTROs at a time when RBI is already engaged in Operation Twist? In fact, the governor pointed to the success of the monetary transmission. But how much of this was really because of Operation Twist that I would call somewhat artificial? And how much of this was really because of structural improvement in transmission? Also, the governor asserted that Operation Twist was aimed at the corporate bond market, not to lower interest rates on government securities. I'm not quite convinced with that argument. Are you, Jayesh?
And I think the biggest challenge for us, let's be very clear, we are a bank-led economy, right? So, some people may say that whether corporate bond market or stuff like that is like 114-15% of GDP in US, and whereas in India it's only 18%. But one has to also look at the AUM of mutual funds, insurance companies, and pension fund in case of US, and for us, Provident Fund, as compared to India, which is at 30% or less than 30% of GDP. This is something at 213% of GDP. So I think, we are predominantly a bank-driven economy, and therefore you do need support and nudge from the central bank at times. LTRO is a great thing, particularly I'm really surprised nobody's really talking, people talking about only bond market, but theoretically speaking, up to 4.75, you don't have CRR, SLR on LTRO. Now any bank who has excess SLR up to this 1 lakh window is available. Technically, he's taking any deposit, any above 4.75, mathematically does not make sense. Maybe some other relationship reason, or that is a different story, but mathematically it does not make sense. And if you bring down your deposit rate, which has to come down, and therefore it will have direct impact on your MCLR calculation, because that's a formula-based calculation. So I think that will push up the transmission. Sometimes when the people don't do it on their own, you need to nudge them, and I think it's a great nudge by incentivizing people. So it's not nudge for the heck of nudge.
Jayesh, I would agree with you on most things, except the fact I worry whether we're repeating the mistakes of 2008-9 when we went really overboard with supplying the markets with liquidity. In fact, Suyash, given the arbitrage that we find between the fixed rate term repos at 5.15 and the yield on government securities of the same maturity, about 5.85, what is there really to discourage banks from taking money from the RBI and investing it in G-Secs? Is the entire purpose of that lost then, Suyash?
So that could very well happen, in the first set of operations. And in fact, if you look at monetary policy globally, there is always a risk that although monetary policy traditionally operates to incentivize lending, but actually it just ends up pushing down market yields, and that's something that can very easily happen here as well, because you can't influence credit risk appetite of lenders. You can influence market risk appetite through these operations. But to support Jayesh's point, we think counter-cyclicality in monetary policy is very essential. So to some extent in fiscal policy, but fiscal is extremely constrained, as we all know. And we can't really fault the RBI for the counter-cyclical approach that they are showing to monetary policy. And by definition, these are short tenure measures. So to your earlier point, whether transmission sustains for longer, these are by definition shorter term measures that the RBI is invoking. Also, the comparison to 08-09 necessarily, although directionally you may argue, but necessarily we don't agree, because the quantums involved were very different then. Both fiscal and monetary easing was very substantial, not just here but globally. And the stimulus was allowed to last for a much longer period of time, and that ties back to the point I made earlier, that in this phase counter-cyclical aggression on monetary policy we can't dispute. But let's say 6, 9, 12 months down the line, should the time arise that there's more green shoots on growth and aggregate inflation is showing stubbornness, that is when the RBI will also have to be quick to unwind this. But as things stand, we are of the view that policy is lower for longer. and probably for the next 1.5 years, therefore RBI will have an easing bias on monetary policy, also given the global context of growth and inflation.
Oh yes, but the problem in all this is we'll never know until much later. In fact, Jayesh, what is your best guess of the government securities that the government will allow non-resident investors to buy without any caps? How long term would they be? Will there be a lock-in? Also, monetary policy normally affects only the short end of the yield curve, but the RBI is now trying to influence the long end as well. So is it being overly ambitious, Jayesh?
So 2 points. As far as the non-resident thing is concerned, I think it's a long situation on getting into global indices. And I think regulators are not comfortable and opening up entire $800 billion to foreigners, because that could create hot money and stuff. This is kind of via media where you put 1 or 2 or 3 or 4 securities into indices. Now, as of right now, the cap on each issuance is like at 1,25,000 crores. That's a, I think, somewhat 3-year process where they revise it upward. I think it's almost like 2.5, 3 years. So maybe we may see that revision coming, maybe 1.25, 1,25,000 crores may become 1,75,000 crores or so on an outstanding basis. So that's one thing which is very more, getting and attracting and maybe at least setting up the foreign investors. So that's one part of it. But I think in terms of short end of the curve, yes, they did try. So if you really look at it, of course, the headline 10-year, everybody tracks that. They did try. The first twist was aimed at 10-year. And then, then second operation twist, and the third, they actually included more securities. So I think that's what they are doing. And now, of course, with the LTRO, which is again squeezing the short end. So I think they are working on the entire yield curve, and I think that should really help the banks to lower their cost as well as look across, because if you are getting a government bond at maybe 1.5% overnight rate, why would you kind of try to do anything else or take credit risk? But if that becomes unattractive, you will have to start looking at the credit risk.
I hope you're right in that, Jayesh, but I'm afraid it's time for us now to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili. I'm in discussion with 2 experts, Suyash and Jayesh, on the implications of the recent announcements, both in the budget and in the monetary policy announcement, on the bond market. Suyash, let me ask you a larger macroeconomic question. Should we really be encouraging debt flows driven purely by interest arbitrage at a time when we are already experiencing very strong inflows? Forex reserves are at all-time high, and further inflows are likely to result in the rupee appreciating precisely at the time when exports are already performing poorly, necessitating RBI intervention in the forex markets to buy dollars, infusing rupees at the times when we already have some worries about whether these surplus liquidity could lead to asset bubbles and possibly even inflation.
So, the underlying backdrop here is that our total financial savings of households have unfortunately been progressively declining over the last few years. Because investment to GDP also has been falling, our current account ratios have largely been intact. So cyclically, current account deficit is probably down to now 1% of GDP. Which allows some room to be able to tap offshore capital in the near term slightly more aggressively without quoting macroeconomic risks. So, if let's say our current account was somewhere close to what it was in 2013, which is 5% of GDP, then obviously it's a very risky proposition to try to finance that through large scale capital inflows from abroad. But as things stand, if you look at basic balance, which is current account adjusted for just your sticky FDI flows, we are actually positive on basic balance, which is a very happy situation to be in, and therefore, tactically some more risk can be taken with respect to aggressively quoting offshore capital. The RBI has made one change to its liquidity framework, which will probably help mitigate the liquidity impact. Is basically they have done away with quantitative targets on liquidity as we read it. They are just focused on the weighted average call rate. So theoretically, they can allow excess liquidity to float around. Your point is valid that they have to look for spillover effects to asset markets and probably some sort of behavioral changes down the line. But in the near term, I think we are okay to do that. In fact, this is something that was required given that local savings or local risk appetite has fallen short of financing some of our needs, either for investments or borrowing by the government of India. But you're absolutely right. Over time, it's local savings that need to come up. And for that, more attention also has to be paid to income growth in the country.
Oh, absolutely, because with foreign investors, particularly in the debt markets, it's always easy come, easy go. And Suyash pointed to the comfort that we have in the current account. But the fact is, one spike in oil prices and all the comfort disappears. In fact, the proposal for the sovereign borrowing in last year's budget was shot down purely on concerns that this may have for macroeconomic stability. The belief seems to be that overseas funds investing in rupee debt is safer. But as the experience of the Southeast Asian countries goes, this could be false comfort because there is the issue of externalizing the debt. And if and when investors decide, for whatever reason, to flee, you could have a huge repercussions for the forex market and also for the country's macroeconomic stability. So should this not be a concern, which I think is not there at the moment with the Reserve Bank of India? Jayesh?
No, so I think even if they come in rupee bond, there is a concern of money flowing out, and just when you ask the last question, I just want to say, there is nothing like we can attract them. All we can do is basically make enablers, make it comforting and enablers. So as of right now, we are almost having 5.5% as a limit, which is like 4 lakh crores odd amount, right? And while getting inclusion into index is more of an enabler rather than forcing them to come in. And I think some of the flows, ultimately there is no way we are going to attract them. It's all about going to happen about what happens in the global macro. So some of the flows which we are seeing recently, I think, was actually little bit lead lag effect, because of the global situation, coronavirus and other stuff. Other emerging market did get money, but we didn't get enough or we didn't get anything because people were waiting for the budget, right? Because that was a big event as far as the local bond is concerned. So once that was behind, and that's where you see the foreigners coming in. So it is more about entire emerging market, and we are not going to be different. I think your rollover risk isn't the currency, and that may not show immediately, but sometimes maybe down in future when your rollover risk comes in and you have a 2008 like of situation, that could be risky. And of course there is a cost factor too, right? You borrow at X, then you give that dollars to RBI, who deploys that in US Treasury. So it's from a country perspective, it's a negative as long as we are able to manage locally.
That is, of course, a big if. So, Yash, but you talked about the new liquidity framework. What are its implications really for the bond market? Can it take comfort that the RBI will always be there, or is that false comfort? So, Yash?
So I think what they're also trying to do is by removing the overnight and predictable repo windows, they are basically asking banks to be more self-reliant on their cash management requirements. In the near term, what it may mean is banks keep more precautionary liquidity with them, which may have the implication of driving down overnight rates slightly further lower. But I think in the medium term, as the system evolves to more term repo, reverse repo structures, banks will also have to be more on ball with predicting their cash management requirements. On this other aspect of doing away with liquidity targets or that 1% NDTL that has been in place for a while, again, in the near term, since we are certain that RBI wants to keep excess liquidity in the system, there is no confusion with respect to this aspect. It will be interesting to see how this evolves at a time, let's say 2 years into the future, when monetary policy is called upon to tighten and make financial conditions restrictive. And that is when, how the guidance evolves on what quantity of liquidity remains in the system, or the system is allowed to be in deficit mode and weighted average call rate is the only target that RBI looks at, will come into play again. But for the meanwhile, I think it's a happy circumstance for the bond market as well as for transmission.
Okay, happy circumstance for the bond market right now. But I really do not know what the future entails, because after all, inflation is the big bogey in India. Jayesh, do you agree with Suyash's assessment? Also, there seems to be a great deal of anticipation, expectation, and you also spoke about it, about India's inclusion in the bond indices. What are the other conditions we really need to satisfy before we can include it? And is inclusion all that it is made out to be? Yes, you might get some more inflows, but on the flip side, there is the fear that it encourages herd mentality. And if for any reasons funds decide to pull out, you could see a repeat of the taper tantrums. I think you also mentioned that. Jayesh?
Yeah, I think, yeah, that risk remains, and that's why your reserve maintenance, whenever there is dollar strengthening, this is, see, let's be very clear, till index inclusion comes in, this is investment into fixed income in India. It's not about interest rate arbitrage, it's also about currency play, right? So 70-80% of the players are actually more tracking currency. And what's your view on currency? If you think the currency is depreciating, they are all going to go out. So that risk is definitely there, and that risk we have to manage. But yes, there are certainties. There are things we don't know. But as of right now, people are going with the base case, maybe Q3 or inflation will come under control, and that's what the thing is. But of course, there are a lot of things to monitor. Your oil is soft. We don't know how this virus thing goes away. It takes 4 weeks, it takes 8 weeks. The situation would be very different. There will be supply side shocks if it takes 8 weeks, and that can hurt inflation. Oil's down right now, but can it rebound? It can rebound with vengeance when the things settle down. All the things we will have to see. But as of right now, okay, we have a vision. We're looking at third quarter at getting into the MPC target rate, but that's what. But during the journey, we need to look at all these possible scenarios, and I'm sure RBI is also going to look at all these possible scenarios.
Yeah, okay, Jayesh, you seem to have more faith in the RBI than I do, but maybe I'm just being a cynical journalist. But Suyash, do you agree that inclusion in the bond index is not necessarily an unmitigated good? So perhaps we should think 10 times before we really try to get onto it.
But Mythili, the impression we get is that's precisely what they're doing. So if you see, what they're saying, they will start some special bonds where they will wait for critical mass to build, so to speak, and then they will, kind of engage with the index providers for a limited amount which only is restricted to those particular bonds. So I would think, and this is also, if you remember last year, this issue of sovereign bond announcement, which was subsequently scrapped. I think the RBI is very much on the same page as you are on, and in fact all of us are on, that they don't want to open this to a very large extent. At the same time, with greater globalization and greater constraints on domestic savings that are being put upon because of the financing needs of this country, you can't entirely be agnostic to that flows.
Okay, Jayesh, we keep talking about the bond market, but we forget that the bond market in India is overwhelmingly dominated by government securities, and corporate bonds are just a very small little part of it. And though we've been singing the praises of the corporate bond market, the fact is that underlying the corporate bond market is the fact that contract enforcement is critical to that, and contract enforcement has been woefully inadequate in the country. So do you expect the corporate bond market to really pick up in the absence of necessary legal reforms to ensure that contract enforcement gets the validity that it needs?
I think Mythili, our corporate bond market is more of our bigger structural issue. Yes, these are all enablers. When we say contract enforcement and all this stuff, it is good. It are all enablers. I think the biggest challenge is ultimately your individual savings. It comes to the financial market in 4 ways. One is either 5 ways: directly, or through insurance, or through pension, or through mutual fund, or through bank deposit. Now, unfortunately, for historical reason, our bank deposit always has been very attractive, right? And so therefore our biggest corpus is still in the bank deposit, and till we get into Ind AS and other stuff, loan is a non-mark-to-market product. So banks generally prefer loan. Unfortunately, in last few years, even that is also not a preferred route. But yeah, the bank generally prefer loans, and that's what is more of a structural issue for us. And that's where wherever you have the financial market developed, that's why I gave you an example of the AUM of insurance, mutual fund and pension in US as compared to GDP is very high. And Mythili, since I got this opportunity, I also want to, give this, this is something very dear to me on the myth. which has been created about the small savings, and the small savings rates are the dampener for transmission. I think it's not really competing with bank deposit. If you look at bank deposits, 1,30,000 crores plus. Small savings all put together is not even 10-15% of that. These are all long-term money. And secondly, even if you remove the compulsory investment, it's not even 5%. So what are we saying that is a competition?
Oh, I couldn't agree with you more, Jay. And that the problem in India is that you repeat a thing often enough, even if it's completely wrong, everybody just buys it and keeps repeating it completely. Because you can't really compare. The lock-in is much greater for small savings. You don't have the kind of liquidity that you have in bank deposits. But unfortunately, everybody has bought this story, which is why government also is now talking about perhaps lowering the rate of interest on small savings, not realizing that this is something that they're using to finance, in fact, the fiscal deficits. I'm not sure that they'll do it. But thank you so much, Jayesh and Suyash, for joining me in this really interesting discussion on the bond market. Let's see what the announcements that both the government and the RBI have made really do to the bond market. Because yes, we do need it to develop, but there are many ifs and buts before we finally get there. Thank you so much for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.